a new chapter in global finance. The US Fed makes a move. The US Federal Reserve, America's central bank, recently lowered interest rates. This significant decision reverberates through the global economy. It influences everything from stock markets to the price of everyday goods. Understanding the Fed's move and its implications is crucial for navigating the complex world of finance. Lower interest rates typically spur economic activity. They make borrowing cheaper for businesses and consumers. This encourages investment and spending, potentially boosting economic growth. However, this move also carries risks, such as inflation. The Fed's decision sends ripples across the globe, especially to emerging markets like India. These economies are particularly sensitive to shifts in global capital flows and investor sentiment. India, with its burgeoning economy, watches the Fed's actions closely. The coming months will reveal the full impact of the Fed's rate cut. One thing is certain: the world is watching and the stakes are high. Indian stock market, a magnet for foreign investment? The US Fed's rate cut has sparked a surge of interest in emerging markets like India. Lower US yields make Indian assets, particularly equities, more appealing to foreign investors seeking higher returns. Foreign institutional investors, or FIIs, play a crucial role in this dynamic. FIIs are constantly on the lookout for profitable investment opportunities. When US interest rates fall, FIIs often shift funds to emerging markets where returns are potentially higher. This influx of foreign capital can significantly impact Indian equities. Increased FII investment often translates to a surge in Indian stock prices. This creates a positive feedback loop, attracting even more investors. However, this reliance on foreign capital also makes the Indian market vulnerable to sudden outflows. Understanding the motivations and actions of FIIs is essential for comprehending the complex interplay between global finance and the Indian stock market. Bank of Japan at a crossroads to raise or not to raise. The Bank of Japan, much like the US Fed, faces critical decisions regarding interest rates. Their choices have significant implications for global liquidity and the performance of economies worldwide. The BOJ is currently grappling with the question of whether to raise interest rates or maintain their current low levels. If the BOJ chooses to raise rates, it could attract capital back to Japan, potentially strengthening the yen. This move could also help control inflation, which has been a concern in Japan. However, higher rates could potentially dampen economic growth. Conversely, if the BOJ maintains low rates, it could contribute to continued global liquidity. This would make it cheaper for businesses and governments to borrow money, potentially supporting economic activity. However, it could also exacerbate inflationary pressures. The BOJ's decision will be influenced by a multitude of factors, including domestic economic conditions and global financial trends. The world awaits their decision, as it could have far-reaching consequences. The balancing act of the RBI. Navigating global cross-currents. The Reserve Bank of India, or RBI, India's central bank, faces the daunting task of navigating the complexities of a rapidly changing global financial landscape. The recent US Fed rate cut and the upcoming Bank of Japan decision put pressure on the RBI to respond strategically. The RBI must carefully consider the potential impact of these global shifts on the Indian economy. Lower US interest rates could lead to capital outflows from India as investors seek higher returns elsewhere. This could weaken the Indian rupee and fuel inflation. On the other hand, maintaining higher interest rates in India could attract foreign investment. However, this could also make borrowing more expensive for businesses and consumers, potentially slowing economic growth. The RBI walks a tightrope, aiming to maintain a balance between controlling inflation, stabilizing the currency, and promoting economic growth. Their decisions require careful analysis and a nuanced understanding of the global financial chessboard.